More builders will go bust as the construction apocalypse has been confirmed. Let's have a look. Hello everyone, Florian.Heise here, and welcome to another episode of HeiseSays. Grab your stein of coffee because we're going to look at another section from the Financial Stability Review of the RBA. This one, it's Box C, the financial stress and contagion risks in the residential construction industry. Now, we've been talking about issues in the construction industry for some time. Regulars of the channel know that I'm an architect, so I've got a vested interest in knowing what's happening in the construction industry. And it seems to be, it is a big part of our economy here and a tool that the government loves to use to stimulate the economy. I'm going to bring up this little chart or little slither of a presentation I show. What we had is for the government intervening, coming to the rescue of the economy to address the impact of all of their restrictions. They did a lot of things. One was changing the rules. They allowed zombie companies to stay alive. You could trade while insolvent. Normally every year you got to do the paperwork, pay some money to ASIC to say that you're not insolvent. That's pretty much, no, it doesn't mean anything really. ASIC doesn't do much, do they? But still, they changed those rules because you're meant to, and as a business person, you're meant to be able to trust that the businesses that you're doing business with have the money to pay their bills as they fall due. But they allowed businesses to keep going. So the danger with that is you can rack up a whole lot of debt. You can really be moving money around from one place to another and just try and keep the machine rolling. But it eventually catches up to you. You can see in this chart the external administrations crashed, and so did insolvencies and all other things dealing with companies, particularly in the construction industry. And that's coming home to roost. We'll talk about that more today. The JobKeeper, that's a whole other thing. Juicing the market too. It's how they juiced the housing sector, overheated it, and we're seeing all of the issues here. Home builder, that's the spike on that bottom graph there, the line going right up. You got grants of 88 grand, now they're even higher. The 5 and 2% government loan guarantees. How's someone on a 2% deposit loan going to handle these interest rate increases? So yeah, it's a mess, and it's a mess because of government intervention. Don't think it's going to be any different now with this government. But we've been talking about this for some time, even a year ago, the terrifying trend in insolvencies. They continue to fall. You think that's good? It's a bad thing because it's going to bounce back. And we're seeing that now. These are the company names of some of them that have gone under. You've got Wolfram, West Point, Langford Jones Homes, Pivotal Homes, Condev Construction, Snowden Development, Tasmanian Constructions Proprietary Limited, Wilborough Homes, Inside Out, Daledom Developments, Home Innovation Builders, ABG Group, New Sensation Homes, Next, Pindon, ABD Group, Solido, Waterford, Privium, Statement Builders, Blay Builders, and FSA Services Group, among just a few that people have shared with me on my channel. We need to start adding a few more to that. So grab a coffee, guys, get your stein, and we're going to go through this entire report. Well, because it's important. Because we're only just starting to see the impacts of this. Every one of these builders that goes under, there's going to be a whole lot of people underneath them. Well, they're not a builder, but they're a Blair builder. A whole lot of tradies, a whole lot of subbies, and there are people under them, there are people under them, and it flows through the economy. This is the same reason why the government loves throwing money at housing, because it gets through the economy really fast. So the debt also gets through the economy really fast. And then, well, from a housing price perspective, I know property prices are going down, but you've got to remember, if we lose a lot of builders and a capacity to put more stock on the market is hampered, and new builders even more expensive, you tell me what it's going to do to house prices. So let's look at this. The residential construction industry in Australia is facing challenges due to the sharp rise in construction input costs, compounded by shortages of labour and materials, which has eroded profit margins on existing fixed price contracts. I'm assuming they have to be apolitical here. They probably aren't going to make mention of the political overheating of the sector. Maybe they will. We'll see. So graph C1, where is it? Here's C1. Is this C1? Yes, graph C1. Here's, oh boy, look at that material inflation. Look at that material inflation. 15%, over 15%. Look at construction insolvencies. There is the decline. And here we go. We've bounced right back. And this is the estimate of where it's going to, year-end estimate. Year-end growth, input of housing construction. Oh, here's new external. The dot is September quarter estimates. So like I said, the construction insolvency cliff, there you go. Shot right back up. It's overtaken everything since 2014. Reflecting these pressures, a number of large residential construction firms have entered into insolvency over the past year. Overall, construction company insolvencies have increased sharply, exceeding their pre-pandemic levels and accounting for close to 30% of all company insolvencies. More recently, the increase in interest rates has begun to raise debt servicing costs for many firms, adding to financial pressures. Further increases in insolvencies are likely, while the direct implications for the financial system are limited because banks have very small exposure to builders. There is potential for financial stress to spread to other businesses within the broader construction industry and to some households. Yeah, you think? Oh, the financial sector will be fine. So all the jobs that the people in the RBA can jump to will be fine. But the rest of us that are tied into the construction industry, we're screwed. Oh, boy. Oh, it's fun and games, isn't it, guys? That's why I'm wearing my happy shirt today. So, profitability has declined for most builders, and margins are likely to remain under pressure in the near term. I mean, because could you have anticipated this as a builder? This insane inflation. Not when, look at this, this is all they're used to. If you were anticipating 15% inflation, you wouldn't win any job ever. Builders typically offer contracts to build homes at a fixed price with considerable lead time. Well, because they have to. Which has left many builders exposed to the sharp increase in the cost of materials and labor since the start of 2021. The cost of building materials alone has increased by more than 20% over this period. As such, profit margins for existing fixed-price contracts have compressed substantially, and builders are now making losses on some contracts. Ongoing delays as a result of supply chain disruptions, inclement weather, and illness-related workers' absences have resulted in further increases in costs and have delayed when payment milestones are reached. According to industry contacts in the bank's liaison program, so you get to take, this is how you line up your future jobs at the RBA. It's a different world. It really is a different world. Construction delays for detached homes are currently around 12 weeks on average, and much longer than this in some circumstances. Builders have responded to these challenges by raising the price on new contracts, shortening the period before a quote must be accepted, and renegotiating some of their existing contracts. Nonetheless, the share of medium-sized and large builders who build the majority of new homes, recording negative net operating cash flows in the given quarter, has risen sharply since the start of 2021. This is graph C2, so let's have a look. Where's C2? Where's C2? Do we go over it? What? You know what? Okay, let me bring up the report over here, guys. Let me bring up the report over here. C. Jump over here. Graph C2. Builders with negative cash flows. And here's, I'll zoom in. So over the quarter, medium size. Oh, what? Builders outside of the largest 200 with a turnover of at least 5 million. 1,400 firms. So what is that? Is that over 40%? Are you kidding me? So, 1,400 times 0.4. 560 builders with negative cash flows over the quarter. Over the year, what are we looking at there? Say 30%? 30%. The largest 200, they're not doing much better. Oh, shit. Can you blame people for wanting to get out of the game? We can't, can we? I mean, really, it's just... The likelihood of having persistently weak cash flows over the year has also increased, including for large builders, whose size may have given them some advantages in managing the ongoing disruptions. Over 25% of the largest 200 builders recorded an operating loss in the year to March 2022, up from a little over 15% a year prior. 25%, so a quarter of the largest 200 builders in Australia, the big boys, the chonky boys, had an operating loss to March 2022. So that's here. That's 25% on their chart, guys. Recurring operating losses due to rising costs and delays have led some builders to run down their cash reserves, which were built up through the COVID-19 pandemic, aided by the receipt of government support programs. See, this is where the government intervening and juicing up the market, it's all for nothing. This is where it's a profitless boom. You're so busy, you're losing money. You got to get to the point where you don't go too crazy. You don't work too much. Your revenue can be right up to the moon, and you're making nothing. I remember when our revenue was much higher, when I had a big team. I'm making more and living a less stressful life now, because you just got to keep everything going. You got all these costs. You just disappear. It's nuts. Be worse than this game. Survey data from January 2022 suggests many firms in the broader construction industry were drawing down their cash reserves at a faster rate than firms in other industries. Running down reserves can quickly become problematic for builders because they tend to have lower liquidity buffers, that is, cash and other short-term assets, such as inventories and accounts receivable, than other businesses. As of the latest available detailed data from June 2020, that's out of date, really. Builders' liquidity buffers were typically equivalent to less than 3 months of turnover, which was around 25% lower than for other businesses of a similar size. And that's graph C3, and we'll have a look here. So we can see it. This is non-construction businesses and builders. I mean non-construction, and this is annual turnover. So greater than from 5 to 50 million and over 50 million. So what, not even 3 months? Not even 3 months. The big boys, maybe 3 months. I mean, some of these non-construction businesses, they live in a completely different world, guys. You ever spoken to a lawyer? How they get paid? In response to the financial stress caused by ongoing pressures on margins, information from liaison with banks suggests builders are predominantly working with other developers instead of retail buyers, have to be able to switch to more flexible contracts that allow them to pass high material or labor costs onto their customers, even after the contract is signed. So we're going back to all the ways. But the problem is here, certain legislation won't allow particular contracts to be used for residential construction. Maybe it's time we need to change that. Banks have also responded by working more closely with financially stressed builders to resolve liquidity issues as they arise. However, further insolvencies are expected in the near term as many builders continue to work through fixed-price contracts taken on when costs were substantially lower, and as higher interest rates increase debt servicing costs. Moreover, new and existing fixed-price contracts remain exposed to further increases in input costs. Subcontractors have absorbed builders' financial stress to date, but risks are elevated. Or subbies always have to cop it, don't they? Did I tell you the story when we got done over? We worked with a builder to put a proposal in to win a job, and we'd done a design. This is an extension to a facility, and we won the job. This is after I put my whole fee proposal in. Then we come down, sit down with their project manager to sort out the construction, documentation, and the next stage of the job. And, this is when we're discussing fees, and the fees that they've got are significantly less than what I put in, about a third less. And I go, well, that's not what I put in. And so, oh, that's what I got there. So I had to make the decision then, because I needed that work. I needed to keep the guys going. This is one of the issues when you have a whole team. So yeah, I don't think any of those PMs or people are at that builder anymore. Funny that. So that's the fun of being a subcontractor. Builders rely heavily on engaging subcontractors for concreting, bricklaying, roofing, installation. So, well, yeah, that's all builders do. They're just managers. How many builders actually employ people directly? Which means these businesses are highly connected. Financial stress can quickly spread from troubled builders to these construction services businesses through delays or default on payments for work already done. Oh boy. I mean, what's the longest you've had to wait to get paid? And the problem is, I was talking to Rachel about this the other day, about, we drove past, there's one courthouse where I served papers to get some money back from someone. And that's how she remembers it, and she gives directions now to that. And we needed that money back then because we'd already spent it and someone gypped us on it. That's the problem. For us, it's not as bad as someone who's actually buying a material or cash flowing the installation of things in projects. Like if you're a concreter, what about all the concrete? For the medium builder, around 40% of total liabilities were short-term unsecured trade credit, unpaid invoices, in June 2020, around twice as much as for other businesses. Failures of larger businesses tend to affect a high number of construction services businesses, which in turn have the potential to transmit stress more widely through their own subcontractors. Financial contagion risks in the construction industry are exacerbated by these businesses having higher unpaid receivables than other businesses, typically around 1.5 times their monthly turnover for the largest firms. This is in graph C4. And this is really not selling the construction industry, guys. If you young lads are watching, get into something else. So here's construction services, non-construction, turnover from 1 to 5, 5 to 50, and over 50, you can see, yeah, construction's much higher than everyone else. There you go. To date, transmission of financial stress from builders to their subcontractors appears to be limited. Liaison with banks suggests the majority of subcontractors, this is what they're getting all their data from. What are they doing? How are they liaising? Where's that information? Where can we see the minutes of those meetings? Shouldn't it all be publicly available? Just asking. Maybe that's a question to put to them. We've got to get John Adams onto that one. Where's I want to see behind the veil of this department. So, suggests the majority of subcontractors affected by recent builder insolvencies have been able to absorb disruptions to their cash flows using their cash reserves or existing lines of credit, and some have been able to access additional credit. Yeah, some of the subbies have borrowed against their own house. Some of the smaller builders have gone bust, and they're borrowing their own, mortgaging their own house, borrowing money, doing whatever they can to keep it going. Some subcontractors have also responded to higher risks by shortening payment times for builders, thereby reducing their stock of trade credit exposure at any given time. I've got some mates who would just pay before you even do the work. And the people talk. There's Facebook groups dedicated to dodgy builders. Nonetheless, risks of more widespread financial stress in the construction sector remain elevated. Although construction services businesses are typically able to raise their prices more easily than builders. Ongoing input cost inflation, material delays, and labor shortages are also weighing on their profitability and liquidity buffers. By the start of 2022, the share of construction services businesses running operating losses had declined substantially from elevated levels that followed lockdown-related disruptions. However, net profit margins have generally remained lower than pre-pandemic levels. Graph C5. Okay, let's jump over and look at that one, C5. Here's construction services profiting margin. Here's the median, the 25th percentile. Oh. So what, the 25th percentile are always running at a loss? Get into construction, boys, they say. Maybe it's only good if you're an employee, huh? Reflecting the ongoing challenges, the net operating profit margins at the 25th percentile has declined since the middle of 2021. Going forward, higher interest rates will contribute to increased debt servicing costs for indebted construction services businesses and will increase the risks of insolvency for some. The most vulnerable subcontractors are those that are unable to diversify their revenues and primarily work with one builder at a time. Should that builder default on outstanding invoices, the subcontractor could quickly struggle to meet its own payment obligations. Yeah, that's the nightmare. Honestly, that is the issue. That was one challenge that we had. We'd like get 80% of the work from one builder, and they'd just be ramming us home. And then I'd break into another sector, and then all the work would come from one sector or one client. And now it's not that much a problem because I've got a much smaller team. But when I had a whole team that I had to keep moving, I was keenly aware of that. Particularly when we were doing a whole lot of modular mining work. We had so much coming in. It grew the firm real quick. And then that sector started getting quiet. I had to go out there and look. So, banks' direct exposure to construction firms are low, but there are indirect links through households. Yes, that's how it's going to happen. It's particularly the smaller subbies. Banks' exposure to builders and the construction services industry are small, which limits direct risks to the financial system. Combined lending to the two industries was less than $40 billion as of August 2022, or about 0.8% of total bank assets, and accounted for only a small share of assets at each domestic bank individually. This shows you where the banks want to lend, isn't it? Not to businesses that want to build or construct or innovate. Nah. Just into housing. That's the path of their pain. Some non-bank lenders may have more substantial exposure relative to their total assets, but their market shares are small. As of March 2022, major banks' arrears rates on construction business loans remain very low by historical standards. While banks expect arrears rates to rise following the increase in interest rates, ongoing prudent lending standards for construction businesses should help to contain the magnitude of any deterioration in credit quality. On top of these direct exposures, banks also have indirect links to construction businesses, in particular through households that own and operate small construction businesses and depend on business income to service their own debts. Based on household surveys, around 2% of residential mortgage borrowers are estimated to rely on business income from the construction industry. In addition, many household borrowers depend on the construction industry to some degree, as construction accounts for 10% of total employment. Furthermore, those households currently building a new home are exposed to the industry and are likely to have mortgages with banks. So the banks aren't going to get away scot-free. So risks of transmission to the household financial stress depends on the outlook for construction activity. So the outlook of it. Financial stress remains low for the majority of households that own and operate small construction businesses, as demand for their services, generally trade labor, remains strong. As such, even though net profit margins for construction services businesses are lower than before the pandemic, the additional turnover has partly offset this for many businesses. Personal insolvencies relating to business failures, for example, insolvencies of company proprietors or sole traders, remains around record lows in the construction industry. Graph C.6. Okay, let's check out on that one. Here it is. There you go. Personal insolvencies relating to construction businesses. That's insanely low. Look at that. Look at that. There you go. That's good. That's good. It's going to climb back up, though. We know that, don't we? It's going to climb back up. So continued strong demand for construction work is also supporting employment incomes in the industry and has allowed the small number of workers from failed construction firms to quickly find work elsewhere. That's fantastic. That's good. The large pipeline of work in the residential construction sector should continue to support activity and employment for the next year or so. However, once this pipeline has been worked through, activity is expected to be weaker, given the impact of falling house prices and high construction costs. Risks of broader transmission of financial stress across the industry and to households would increase if residential construction activity slows substantially and input costs remain high. So there we have it, everyone. Let's have a bit of a talk about this. So, well, I'm surprised at how many builders are actually running at a loss. I really shouldn't be surprised, but it's concerning. And, well, at least personal insolvencies haven't crept up yet. We just have to wait for that to happen. But this is showing you just the risks in the construction sector, everyone. The little buffers that they have, not even up to 3 months compared to other industries and other sectors. The exposure they have to just not getting paid and how it can work through the industry. And 10% of people employed in the construction in the country are tied to construction. So more builders are going to go bust, everyone. That's the takeaway. Just have to prepare. If you're in the game, you got to watch that pipeline. You've got to reduce your costs, become more efficient. Don't go buying the jet ski and piss some money away. Build a reserve, particularly if you're in small business. A lot of the budgeting advice online is all for employees. You've got to start planning your next tax bill straight after the last one. You need to have an Excel looking at your monthly projections for the whole year and beyond. As always, thanks for watching. Like, share, subscribe to the channel. Let me know your thoughts and opinions on this one in the comments down below. And check out my other channels, HeiseBim and HeiseSays International, for other content I discuss. And if you're a fan and want to support us financially, you can on YouTube or Patreon, using our referral links, buying our Pocket Squares or merch, or calling us if you need an architect. Take care, everyone. Have a great day. And I'll see you next time.